Leveraged ETFs. I love leveraged ETFs for long-term investing. Leveraged ETFs such as the TQQQ and UPRO, QLD, SSO, and now I'm pretty sure that some of you are already in the comment section saying, oh, leveraged ETFs are not suitable for long-term investing. In this video, I'm going to show you why I politely disagree, okay? In this video, I'm going more specifically to show you what kind of returns do leveraged ETFs return actually. Because a 3x leverage ETF will return 3 times the daily return of the underlying, which in this case for TQQQ is Nasdaq 100. It will deliver those 3x, right? Daily. But what does that mean at the end of 1 year, at the end of 5 years, and at the end of 15 years? At the end of these periods, the returns are not exactly 3x. Okay, they are different. But is it better or worse? And according to whether it's better or worse, you might be able to invest in these leveraged ETFs. Okay guys, my name is Henry. I've been investing for the last 20 years. I'm a hedge fund manager. I'm based in Hong Kong and I have used leveraged ETFs to retire early. You should check all my other videos. Give it a like and subscribe because really, the content that I produce can fast forward your retirement by many years. But without further ado, let's get straight into it. I want to start this video by sharing here the prospectus of the Ultra Pro QQQ, the 3x leverage. And what ProShare says here, as you can read, is that the fund does not seek to achieve 3 times the daily performance of the index for any period other than 1 day. And that's very correct, because for any other period other than 1 day, you will have returns that are very different from those 3x. And usually, leveraged ETF haters will say that there is volatility decay and time decay, and that over the long term, these ETFs always underperform, which is, by the way, just between us, a big lie. It's a misconception. Those people don't understand about math, okay? I'm probably the person in the world that studied leveraged ETFs the most. I have a 4.5-hour long course that you can check in the community, in the link below. Anyway, I'm not here to try to sell you anything. I just want to show you the power of leveraged ETFs. And let me show you by first showing you the returns every year. And I'm going to show you the returns over 5-year periods, okay? I'm a fan of long-term investing with leveraged ETFs. So what does it happen if you invest in 1-year periods, 5-year periods, and a 15-year period? How many multiples would you have compared to QQQ, the Nasdaq 100 normal ETF, okay? So let's jump here into the chart. And what we see here, so these ETFs, they started in 2010, okay? 2010, while QQQ returned 21%, you have the QLD, which is 2x, return 40%, and the QQQ returned 90%. 90% is substantially more than 3x of 21%, because 3x of 21% will be, will be 83%, okay? What about 2011? 2011 was a mixed bag, okay? I have here many other years, okay? 2012, we had QQQ 18%, while the QQQ 46%. 2013 was a very good year for QQQ, while the QQQ returned 32%, the QQQ returned 113%, and QLD, which is the 2x leverage, returned 68%. What about 2014? 2014, while the QQQ returned 18%, the QQQ 49%. So some years are very good, and others are a little bit mixed. 2015, actually QQQ underperformed because 2015 was a very volatile year. So in years where the market is just sideways, these ETFs will indeed underperform. But the thing is that you don't know whether the year will be sideways or it will go up. So the best is just to buy and hold for the long period, because then you'll have years that perform very well. 2016, QQQ returned 55% against 13% of the QQQ. 2017, what an amazing year. Just look at this. While the QQQ non-leveraged version returned 36%, the QQQ returned 124%. So you get the point here. The years that are bear market years, QQQ underperforms, where if you have a bull market year, look at just 2019, QQQ returned way better than the non-leveraged version. Okay, but I have made here an Excel spreadsheet to actually show you the returns, the multiples of returns. And as you can see here, I added the QQQ, QLD, which is 2x leverage, and the TQQQ, which is 3x leverage. Okay, and what we see here is that both on the QLD is supposed to be 2x, right? And the QQQ is supposed to be 3x. Some years, they will deliver more than 2 and 3x respectively. Other years, they will deliver less. For example, 2013, the QQQ returned 3.5x. 2016 returned 4.25x, okay? So other years it returns only 2x actually. Depending on the volatility, you might have a little bit more or less. Okay, so over 1 year periods, sometimes indeed they don't deliver the 3x, it might deliver more or less, but the average multiple is actually on the QLD, the 2x leverage delivers 1.65x of the underlying, while the QQQ delivers 2.17x of the returns of the QQQ on a yearly basis. But things change substantially when we look at 5-year periods. Look at this beauty, okay? Over 5-year periods, so if you hold these ETFs that people say, oh, don't hold, it is not suitable for long-term investing. Yes, it is. Yes, it is. Just look at this. While QLD over 5-year periods on average returns 2.29x, okay, so not 2x, 2.29, so you have a compounding effect, right? The QQQ returns almost 4x over 5-year periods, 3.85, okay? Okay, now it's like this. Of course, these leverage ETFs are more volatile, okay? They, you know, if it goes up 1%, it goes up 3%. If it goes down 1%, it goes down 3%. They are more volatile. But markets are biased to go up, okay? Nasdaq 100, S&P 500, the US stock market, on average, they go up year over year, okay? Look at this chart here. This chart shows the stock market loss rate by holding periods. If you hold the stock market for a 1-day period, you lose money 44% of the time, okay? But if we are talking about 6 months periods, 24% of the time you lose money. 1 year periods, only 19%, okay? And of course, the leverage ETFs have similar behavior. If you are holding for a long period, the more likely you are of making money and not losing money. And over 5-year periods, since 1950 to 2024, in every 5-year period, you had only 5% a chance of losing money. So this 5-year period is actually, it's much more ideal to hold a leveraged ETF. What about if you hold it for 15 years? 15 years, it's a crazy number. Just look at this. Over a 15-year period, the QLD, 2x leverage, actually returned 5.25 times the QQQ, okay? And QQQ over a 15-year period returned 15 times, okay? So while the QQQ returned 1,400%, the QQQ returned 21,000%. These numbers are absolutely crazy. Let me just zoom out here the chart so that you see the full picture that I'm talking about. So this is what I'm talking about, okay? Look at just these returns. The QQQ was absolutely amazing, right? Of course, again, volatility and all that stuff. But if you allocate a small percentage of your portfolio, okay, I'm not saying to go all in. Never do that. Never go all in. Because if tomorrow you have a crash, these leveraged ETFs will be very, very painful. So this is not financial advice. I'm just sharing what I do and what the possibilities are to fast forward the compounding effect of your portfolio to fast forward your retirement. But if there is a crash tomorrow, it will be painful. The thing is that most of the time, like I showed you before, the market is actually going up. And if you are holding these things for the long term, most likely you will make money. Okay, there is a 90-something% probability that you make money if you hold it for the long term. Okay, so even like, look at this, in 2021, 22, Triple Q declined by a lot, but in the meantime, just look at this magnificent recovery. It's absolutely crazy. Okay, and if you held it for all these years from 2011 until now, you have made a shit ton of money. Actually, there is another video, probably you can search it on my channel, where I talk about how much money would have to invest 15 years ago to now have $1 million. Okay, and it was like to investing in the QQQ, you'll have to invest, I don't know, $100,000 or something like that. I cannot recall, or $200,000. Do you know how much you will have to invest on Triple Q in order to have $1 million 15 years later? Take a guess. I will stop just for a second. Did you guess 50,000? No, much less. 30? Nope. 10? No, much less. It's $3,000. It's absolutely crazy, right? We invested $3,000 15 years ago. I had $1 million. So this is why I like these leverage ETFs, because they can really give you outsized returns. Can give you such an asymmetric bet that, like, over the last few years, if you have invested in leverage ETFs, you just close your eyes. You know, psychologically, these ETFs might be tough because when there is a market downturn, there is a huge ton of volatility, but you close your eyes, don't touch them, and take a look at the performance 10 years later, or 5 or 10 or 15 years later. You might be ready to retire, even if you invest a small percentage. Again, these are all volatile, okay? They increase the volatility of your portfolio, but they also increase one thing that I like to, you need to look at investments from the risk-adjusted performance, risk-adjusted returns, okay? And leverage ETFs, for the volatility that you get even more returns. I have also an indicator here on TradingView where that measures the Kelly criterion. This video is already getting too long. So if you want to learn more about the Kelly criterion, it gives you the optimal leverage for each asset. I talk a lot about it on my community, on my leverage ETF course that you can find in the community. Check the link in the description. Anyway, I cannot pack so much information in this video. That's why you should check the community where I have people that have already retired from my investment strategies. And if you find this video useful, give it a like and subscribe, and I'll see you very soon. Bye.